Avesoro is an existing gold producer. We have two mines, one in Burkina Faso and one in Liberia. We produced 220,000 ounces of gold last year, and we have guidance of 210 to 230,000 ounces of production this year, split roughly 50-50 between the two mines. Market cap at the moment is 100 million US. That's come off significantly during the last couple of months or so. We had one of our institutional investors, a hedge fund actually sort of went into administration, and the administrator was selling into the market. And the free float that we had sort of struggled to pick up the volume that was being sold, so that put quite a lot of pressure on the share price, and it's still coming back from that at the moment. In terms of the AISC, just to sort of make a comment on that, you can see the number there, 1100 to 1190 an ounce. That's particularly high this year because we have a high stripping load at the New Liberty mine, which was always in the mine plan, but it's something that needs to be addressed now. So there's around $30 million of capital cost associated with excess waste stripping that we're taking care of this year. So you can see the production profile historically. We just to sort of give some context to that, we came into the New Liberty mine back in 2016. The company was basically bankrupt, so we as a new management team came in and refinanced the asset, and you can see that we've brought the cost down significantly from an asset that was underperforming to a very good performance last year. The group AISC was around $1,050 an ounce. You can see the significant increase in gold production that occurred in the first quarter of 2018, which is when we acquired the mine, the Youga mine in Burkina Faso, and obviously that production included within the public company. We had very high grades in the first couple of quarters of 2018, and now it's sort of normalized at around 45,000 ounces, and we're expecting that to increase to support the guidance number that we have in the market currently as we move through the remainder of 2019. So in terms of cost efficiencies, we've put additional 43101s out into the market for both of the mines earlier this year. We have some cost targets that we're working towards within those 43101s. So there's a significant headcount reduction program that's ongoing within the asset at the moment. We're also looking at transitioning to contractor mining. We already mine ourselves at a very low cost. That's one of the things that we've done historically with both the Youga mine that we acquired from Endeavour. We brought the mining cost there down from around $4.50 a ton to we're mining at around $1.60 a ton in Burkina Faso. And the New Liberty mine that we acquired when it was basically bankrupt was around $5.50 a ton. And we're mining, the last quarter was around $1.70 a ton. So that's one of the big cost savings and the way we're able to add value. Notwithstanding that, we've seen an opportunity to work with contractors that we're talking to in Turkey at the moment, and the benefit for that for us commercially is that we can potentially lock in an even lower price than we're actually achieving at the moment, and because it's tied into the contract, it obviously means that it's sort of locked in for the future. It also means that we can reduce a lot of the headcount associated with procurement and G&A costs that we can back charge, etc. So it makes sense, notwithstanding the very low mining costs that we already achieve internally at the moment. We're also looking at the explosives arrangements. It's relatively expensive in Liberia. In particular, there are only two companies in the country that have an explosives license. So we're in discussions with government at the moment to sort of bring another contractor in that will make the market more competitive and should reduce costs. In terms of the 43101s, as I mentioned, there's on the back of that, we basically added 1 million ounces to reserves during the course of this year. So that was on the back of a significant $25 million exploration program that we undertook in the previous year. That's identified. We have two satellite deposits at both locations where there's potential to truck low-grade ore that's not currently within the sort of economic cut-off, so it's treated as waste at the moment, but we're looking at a heap leach project at both of those locations, which could add significantly to the to production ounces in the future. In terms of where we stand with the overall group, then on the back of those two 43-101s that were produced, life of mine production 2 million ounces. That's obviously after the recovery percentage. A mining cost of $1.71 and just under $20 a ton for the processing cost. AISC of $903 and MPV at 1,300 gold, 5% discount of just under 430 million. You can see the production profile over the next 4 years will be tracking around 200,000 ounces on average. By the time we get to 2023, we'd expect to have updated the reserves again and be able to sort of continue at that 200,000 ounce a year plus production level. There's significant upside potential for the reserves in terms of underground and also from the satellite deposits that I mentioned. So to put it in context, this is what we managed to achieve with the updated 43-101 at New Liberty. So you can see we doubled the production, doubled the reserves from just over 700,000 ounces to almost 1.4 million ounces in reserves. We have a smaller open pit and we go underground at New Liberty within the new plan, which improves the economics significantly on the project. And we also have this satellite deposit called Dublama, where we have first reserves for 400,000 ounces and significant potential to extend that in the future. You can see the impact that that's had on the life of mine. The grey bars there are the previous 43-101. So effectively the mine was going to finish in 2022 and we've now extended that out by an additional 7 years. Quick overview of the financials. You can see the post-tax undiscounted cash flow of $370 million. We have an upfront capex requirement of around $36 million for the underground. The models indicate at the moment that can be self-financed from operations, and we're sort of looking at that as we progress through the current year. Just to sort of focus where Dublama is, this open pit satellite that I mentioned, so it's 45 kilometres from the mine. The plan is to truck that ore and transition the open pit mining fleet from New Liberty to Dublama in year 3. You can see from the underground mine design, which is in the 43-101, that we only go underground 300 metres at the moment, but we have drilled to around 700 metres vertical. The ore body appears to be continuous. We just don't have the drill density to put that into reserves, but there's significant potential to increase further with that as we sort of move on with the project. For Dublama as well, Dublama and the 400,000 ounces or so of reserves that we have there at the moment is only from 1 kilometre of a 13-kilometre gold belt that sits on that granite intrusion. You can see some of the drill intercepts from Leopard Rock right round to Gondosia. Some very, very good drill intercepts, 4 metres at 18 grams and 30 metres at 3 grams, and that's fairly representative of what we're seeing. So the potential here to continue to step out and drill off that strike and add additional open pit ounces to the mine life is very substantial. Similar story at Youga with the updated 43-101, to a slightly lesser extent, but a 23% increase in reserves, a substantial increase in the mine life. And I think particularly to focus in the earlier years, we've boosted the expected gold production significantly, so up to around a sort of 100 to 90,000 ounces on average for the production in the earlier years. We're also looking at increasing the mill throughput capacity. We have a study ongoing at the moment which would basically take those later years and fold them on top of 2024 onwards to maintain that sort of higher level of production. So again, the quick overview of the financials there. Post-tax cash flows, there's no debt on this project actually, $173 million, upfront capex requirement of around $10 million, which again we're expecting to take in our stride on the back of production cash flows. A lot of the increase in the reserves comes from Aware. Ware was a license we acquired at the same time as we bought the Youga mine from Endeavour. So there's significant potential there to drill out that satellite further. It's still open along strike, so there's a lot of potential to continue to add mine life and improve the economics. And again, just a quick summary of the production guidance for this year. So 210 to 230,000 ounces. The AISC is high for this year, but life of mine is around $960 an ounce. So you can see that it's significantly higher in this period, and we expect that to improve in any event as we continue to build out the underground potential and the open pit potential of the two satellites. We expect the economics to improve significantly beyond what they are now. Thank you very much for your time.